Welcome to the Deep Dive, brought to you by Talk Tickers. We're here to cut through the noise of earnings calls and distill the critical insights that truly matter to you.
And today, we're taking a deep dive into ManpowerGroup's second quarter 2025 earnings results. We're going to unpack the raw numbers, explore management's strategic perspective, and then really identify the key takeaways so you walk away truly well-informed.
It was certainly a quarter with some, mixed signals, let's say, on the surface. But management highlighted some encouraging signs of stabilization and, real progress in their strategic initiatives.
Definitely some green shoots appearing.
So let's unpack this and get right into the highlights for the quarter. Kicking things off with their top-line performance, which is, often our first indicator of market health. ManpowerGroup reported revenue of $4.5 billion for Q2.
Right.
Now, that was down 3% year over year in what they call constant currency, meaning we're stripping out the ups and downs of exchange rates to see the true underlying business trend.
Exactly. But their system-wide revenue, and this includes their growing franchise base, actually reached $4.9 billion. So a slightly different picture there.
Okay, and profitability, how did that look?
On the profitability side, adjusted EBITDA, that's earnings before interest, taxes, and amortization, adjusted for, one-time events, giving us a cleaner look at their core operational profitability, came in at $89 million.
Which sounds like a drop.
It is. That's a 25% decrease year over year in constant currency. The adjusted EBITDA margin was 2.0%, a 50 basis point decline from the prior year. But here's the kicker. It notably landed at the high end of their guidance range.
Okay, so better than they'd forecast internally.
Precisely. That's a key signal.
And here's where it gets really interesting for you, because it shows the complexity of these reports, right?
Right.
While their reported earnings per basic share showed a negative $1.44, primarily due to restructuring and non-cash impairment charges.
Big one-offs there.
Exactly.
Yeah.
But their adjusted earnings per diluted share stood at 78 cents. Now, that's still a 43% decrease year over year in constant currency, but it actually came in 8 cents above their guidance midpoint.
Yeah, a meaningful beat, like you said.
So what drove that beat? Was it just one thing?
Absolutely not. This beat wasn't just a fluke. It was driven by a stronger operational performance than anticipated, slightly fewer weighted average shares out there due to their share repurchases.
The buybacks helping the per share number.
Right. Plus a favorable foreign currency impact and better interest and other expenses. What's also notable is their organic days adjusted constant currency revenue, which is a really precise way to measure underlying sales.
Yeah, strips out a lot of noise.
It does. And that only decreased by a favorable 1%, better than their midpoint guidance of a 2% decrease. This tells us the underlying business performance was actually better than maybe the headline number might suggest.
Okay, let's pull back the curtain a bit more on these numbers then. Starting with gross profit. Their gross profit margin for the quarter was 16.9%, which was, slightly below the low end of their guidance. What was behind that?
Yeah, good question. This was primarily due to shifts in their client mix, particularly towards larger enterprise accounts.
Right, bigger clients, sometimes tighter margins.
Often, yeah. Those often come with slightly lower staffing margins, leading to a 30 basis point reduction from that segment. Permanent recruitment also saw a 10 basis point reduction, although that business line remained relatively stable, just at lower levels.
Okay.
What's fascinating here, though, is that while the consolidated gross profit was still down 5% year over year on an organic constant currency basis, it actually showed a slight improvement from the 6% decline we saw in the first quarter.
So the rate of decline slowed down.
Exactly. This indicates a potential bottoming out in some areas, suggesting maybe the worst of the margin compression might be behind them.
Interesting. Okay, beyond the income statement, the real health of a company often shows up in its cash flow, right?
Mm-hmm.
And here we saw some, interesting dynamics.
Mm-hmm.
The second quarter saw a free cash flow outflow of $207 million, larger than the $150 million outflow in the prior year. What were the specific factors influencing that? And, is it a cause for concern?
Well, it's important context here. Historically, ManpowerGroup's first half of the year typically sees negative free cash flow. It's just the seasonality of the business.
Right. Payments, timing, and such.
Exactly. Followed by strong inflows in the second half. This pattern is expected to hold, so it's not entirely surprising. This particular outflow was influenced by several factors. the timing of payables, a large tax transition payment, some technology prepayments, and the timing of managed service provider program payments.
Okay, so a confluence of factors.
Yeah. Also, their day sales outstanding, which tells us how long it takes them to collect payments from clients, increased by about a day to 56 days. Not ideal, but not alarming.
And they're still buying back shares.
They were. Repurchased 230,000 shares for $12 million, with 2 million shares remaining under their current program, and net debt stood at $996 million at quarter end, which, again, typically peaks in June before improving in the second half.
Okay, so while the outflow number looks large, much of it seems to be about timing and expected cycles.
That's the assessment, yeah. Less of a red flag than it might appear at first glance.
Got it. Looking at their global footprint now, the picture remains mixed, but again, with some encouraging signs popping up in certain areas. How did the Americas segment, representing 23% of consolidated revenue, perform?
The Americas segment saw a 2% increase year over year in constant currency, which is, positive overall. Within the U.S. specifically, revenue was down 3% on a days adjusted basis.
Okay, so U.S. lagging the rest of the Americas slightly.
A bit, yeah. What's really driving things here is kind of a tale of three brands within the U.S. The Manpower brand showed strong performance, growing 9% on a days adjusted basis.
Wow, 9% growth is strong.
It is, and management believes they are genuinely leading the market there. However, Experis U.S. revenues decreased 14%.
Ouch.
Yeah, but that was largely due to the non-recurrence of specific healthcare technology projects from last year. So, a tough comparison. Management suggests the 6-month trend of an 8% decrease is probably more indicative of the underlying activity.
Okay, makes sense.
Then their talent solutions in the U.S. showed robust growth, up 13%, driven by their RPO and right management services. So yeah, a nuanced story for the U.S., with strong areas compensating for others.
Right. Let's shift to Southern Europe, which is their biggest segment, right? 47% of revenue. What's the story there?
Southern Europe saw a 2% decrease in organic constant currency. France, their largest market in this segment, saw revenues decrease 6%, but this was actually slightly better than expected.
Okay, still down, but beating expectations.
Exactly. And they anticipate stable activity trends for Q3. What's really exciting within this region, though, is Italy.
Italy, what's happening there?
Continued its strong performance. Increased 4% on a days-adjusted constant currency basis. Management really believes they are leading the market in Italy, expecting continued strong growth there. It shows that even within, generally challenging regions, there are these pockets of significant strength.
That's a key point about diversification. Now, Northern Europe, comprising 18% of revenue, has been a significant challenge.
Understatement, right?
A 10% constant currency decline and an adjusted operating loss of $6 million. The UK down 13%, Germany even steeper at 22%, particularly in auto manufacturing. This really raises an important question. Why is Northern Europe struggling so much more than other regions?
That's the key question, isn't it? Management attributes this largely to the broader economic cycle and ongoing geopolitical headwinds, especially, rising energy costs, particularly in Germany, which is navigating a recessionary environment.
Right.
They also highlighted a crucial difference in many of these markets, the bench model.
Explain that a bit.
So unlike other regions where workers might be hired more project by project, this model means ManpowerGroup often has a pool of workers on the bench ready for deployment.
Good for scaling up quickly, I imagine.
Exactly. Great for rapid scaling in good times, but it means faster deleveraging or, financial strain when demand drops because they're still carrying those costs for people on the bench.
Ah, okay. Less variable cost structure in a downturn.
Precisely. However, they have taken significant restructuring actions there, and they do anticipate an improvement in profitability trends moving forward. They're actively addressing it.
Okay, good to hear. And finally, let's talk about the Asia-Pacific Middle East segment, APME. That's 12% of total revenue. Sounds like a brighter spot.
Absolutely. This segment was a clear bright spot. It increased 8% in organic constant currency. Japan, their largest market in the region, grew 7% and continues its consistent strong performance. It really highlights how geographic diversification is a real strength for ManpowerGroup.
Definitely balancing out some of the European weakness.
For sure. And stepping back from the regional numbers, management truly underscored their long-term strategy: diversification, digitization, and innovation.
Right. The 3 pillars.
Yeah. They've been investing for over 5 years in their PowerSuite, which they describe as an unrivaled foundational tech stack. This platform is essentially the digital backbone that enables all their digital transformation and AI capabilities. It's not just talk.
And this leads us directly to Sophie AI, their enterprise-wide AI platform. It sounds like it's not just a buzzword for them. They're actually deploying it for tangible results.
Very much so. We're talking about tools like a sales targeting engine that can identify leads with 50% higher revenue potential than human intervention alone. That's a big claim.
50%, wow.
Yeah. They're also rolling out a virtual recruiting assistant that automates candidate screening and interviews with the potential to improve recruiter productivity by 2 to 3 times. This is really where the rubber meets the road for tech investment.
But are they seeing that productivity boost across the board yet?
Well, what's fascinating here is that while they're seeing these sort of point-to-point improvements in specific recruiter tasks, management acknowledges that the full impact on productivity will require deeper process transformation across the entire organization. It's not just flipping a switch.
Makes sense. Adoption and process change take time.
Exactly. They also pointed out a significant AI readiness gap in the broader market. 58% of employers are investing in AI, but only 26% believe their workforce is truly ready to use it.
It's a huge gap. And a huge opportunity for Manpower, presumably.
A clear opportunity for ManpowerGroup to step in as a partner for their clients, helping them bridge that gap.
On the market share front, management expressed real confidence in their ability to compete and win business. What's driving that confidence? Is it just the tech?
The tech is part of it, for sure. It's largely driven by their strong pipeline and the intelligent use of their proprietary data and AI to target faster-growing industry verticals with greater precision.
So using data to fish where the fish are, essentially.
You got it. They're not just throwing darts. They're using data to identify exactly where to focus their efforts for maximum impact. They're also continuously evaluating opportunities to expand their franchise model in markets where a more local approach can drive faster brand growth. That's a smart move for agility.
Right. Beyond the front-facing tech that, gets all the headlines, their back-office transformation is progressing well, too, you mentioned. Tell us more about the efficiencies they're seeing there, because that's crucial for margins.
Absolutely critical, yeah. Because back-office efficiency directly impacts profitability. Nearly 65% of their revenues are now running through their PowerSuite back-office platform.
65%, okay.
Which is enabling significant efficiencies in shared service and global business centers. They expect to cross over, as they put it, in the second half of 2026, meaning they anticipate truly significant improvements in operational leverage kicking in then. Similarly, 90% of revenues already run through their PowerSuite front office, and over 70% of their website traffic is managed through a single global platform. It's about creating a seamless, efficient operation end-to-end.
So the infrastructure is largely in place, and the big benefits are expected soon.
That seems to be the message. These are the unsung heroes of their digital transformation.
Okay, shifting to the macro view. Management noted that the heightened uncertainty they spoke about back in Q1 has begun to ease somewhat. They feel client confidence is improving, leading to market stabilization. What tangible signs did they point to there?
Well, it's more a feeling, I think, but they believe employers are proving remarkably resilient. They're absorbing what might once have been considered black swan moments with greater pragmatism.
So less panic, more planning.
That seems to be the implication, a shift from reactive panic to more strategic planning from their clients, regarding things like tariffs and reshoring.
Yeah, that's a big topic.
Management believes clients are really sifting through the noise, seeing the U.S. as a generally positive business environment, and actively considering expanding manufacturing capacity here.
But does that translate directly into lots of jobs for Manpower?
Well, the exact volume of jobs from reshoring remains to be seen, as many of these new roles are highly skilled and automated. But it's viewed as fundamentally beneficial to their U.S. businesses because it creates new, higher value opportunities.
Okay. And looking at Europe, specifically, they mentioned defense and infrastructure spending from NATO agreements potentially having a positive effect.
Yeah, they expect that to eventually have a positive flow-through effect to the broader economy.
Eventually being the key word.
Right. While certainly a long-term positive, management indicated there will be a delay in those funds flowing through and generating widespread economic activity beyond just those specific verticals directly involved in defense. So it's a tailwind, but maybe a slow-burning one.
Got it. Let's talk about what's next for the company then. Guidance for Q3. They're forecasting adjusted EPS between 77 cents and 77 cents and Diller's 87 cents. What does that imply for revenue and profitability?
So their constant currency revenue guidance is between flat and a 4% decrease. The midpoint represents a 2% decrease. But here's the crucial detail. At the midpoint, organic days adjusted constant currency revenue is expected to be flat.
Flat. Okay, that's a definite improvement from the Q2 decrease. Stabilization signal.
A meaningful improvement, yeah, suggesting stabilization is happening. They do, however, anticipate EBITDA margin to be down 50 basis points year over year at the midpoint.
So still some margin pressure expected.
Reflecting continued, albeit slowing, margin pressure, yes.
Okay. Lastly, regarding their dividend, which they reset back in May, what's management's stance on future dividend increases? Are they committed to returning cash?
They really reiterated their proud track record of increases in stable to improving environments. They explicitly indicated that as the economic environment improves, you, the listener, should expect them to lean in and start increasing the dividend again.
So signaling confidence in their long-term cash generation and financial health, even after the reset.
That's definitely the signal they're sending, yes. You know, what's truly insightful here, stepping back, is ManpowerGroup's ability to navigate this really challenging global macroeconomic environment.
Yeah, it's choppy out there.
It really is. They're leveraging their diversified vertical mix, from consumer goods to tech and industrials, and making these strategic, targeted actions, like protecting performance in tough sectors like automotive, while really pushing growth in others, like Italy.
It shows resilience, doesn't it?
It really does. It's a testament to their resilience.
And their continued investment in their digital core and AI platforms, PowerSuite, Sophie AI. It isn't just about cutting costs, is it?
Not at all. It's about fundamentally transforming how they attract talent, how they serve clients, and ultimately how they gain market share. This proactive digital transformation positions them incredibly well for future growth.
Especially with that AI readiness gap you mentioned earlier.
Exactly. That gap in the broader market represents a clear and growing opportunity for them to step in and partner with businesses that need help adapting.
This brings up a fascinating consideration for you listening.
Yeah.
How quickly will that lag from exploration to impact of AI on labor markets truly shorten?
Yeah, that's the billion-dollar question, isn't it? Management's view is that AI is an augmentation of human capability, not a replacement. And that's critical for their core business model, which is connecting people to jobs.
Right, augmenting recruiters, not replacing them entirely.
Precisely. And the success of their, deep restructuring efforts in tough regions like Northern Europe, combined with the momentum they have in high-growth areas like Italy and Japan, that combination will be key to watching their profitability trajectory unfold.
So for you, the takeaway seems clear. In an era of ongoing uncertainty, ManpowerGroup is strategically investing in technology, optimizing its operations to build resilience, and really trying to unlock future profitable growth.
Yeah, even as they pragmatically acknowledge the need for broader economic improvement in some key markets, it's a company actively trying to shape its own destiny, not just react.
All right, it's time for our This Is Not Financial Advice segment, where we pitch an outrageous but plausible trade idea, like a hedge fund analyst might to their investment committee.
Okay, let's have some fun. Given ManpowerGroup's recent earnings call, I think the market might be underappreciating the significant operational leverage potential.
From where, specifically?
From that deep back office transformation we talked about, and the aggressive deployment of AI, particularly across Europe, where things have looked so tough.
Okay. So the market sees the current pain, but maybe not the potential gain.
Exactly. So here's the play. We go long ManpowerGroup.
Long Manpower, what's the core thesis?
The thesis is that the recent aggressive restructuring actions in Northern Europe, combined with the scaling of their AI-powered sales, targeting, and recruiting tools across the continent, will drive an outsized profitability turnaround in these currently depressed markets when the economic cycle finally turns.
Because of that bench model dynamic.
Precisely. They've explicitly stated that the bench model means they deleverage faster in a downturn. Well, mathematically, that implies a sharper, more dramatic releverage as demand recovers.
A coiled spring effect.
That's exactly. They're poised for it.
Okay, a long needs a pair trade usually. What's the short?
To make this truly actionable, we pair it with a short on a European staffing peer, one that hasn't invested as aggressively in back office automation and AI.
And maybe is less diversified.
Crucially, yes. Less diversified geographically, or maybe has higher exposure to the specific struggling industrial sectors in Northern Europe that have hit ManpowerGroup so hard. The arbitrage lies in ManpowerGroup's superior technological foundation and proactive cost management.
Allowing them to capture disproportionate profit growth once demand returns.
That's the idea, essentially turning their current geographic headwinds into future tailwinds faster and stronger than the competition. It's betting on the tech-forward, diversified player winning out when the tide turns.
It's a bet on strategic foresight and technological superiority eventually shining through, especially in the regions that have been the biggest drag. Outrageous, maybe a little. Plausible.
Absolutely, I think so. If you believe in the power of diligent execution and next-gen tech in what is ultimately a cyclical business.
Okay, fascinating idea. That wraps up our deep dive into ManpowerGroup's Q2 2025 earnings call. We've covered their mixed but stabilizing financial performance, the strategic shifts in their business lines and geographies, and their aggressive push into AI and digital transformation.
Yeah, the key message for you, I think, is the company's clear focus on building resilience and positioning for future profitable growth. They're navigating these persistent macroeconomic and geopolitical complexities with a pragmatic approach and significant operational changes that are already well underway.
And remember, everyone, this deep dive is for informational purposes only. It is definitely not financial advice. We always encourage you to do your own research and consult with a financial professional before making any investment decisions.
Absolutely. We hope this deep dive provided you with valuable insights and helped you cut through some of the noise. If you have any follow-up questions or topics you'd like us to explore in future deep dives, please do let us know.
Thank you for joining us on the deep dive. We look forward to speaking with you again on our next deep dive.